Hello and welcome to MBH Online Accounting and Business Solutions channel. For this video, we are going to discuss Philippine taxes. At the end of this video, you'll be familiar with the different types of taxes, their tax forms, and tax rates. But first, let us begin by answering the question, why is it important to pay taxes? The primary purpose of taxation is to raise revenue to meet the needs of the community. Paying taxes are important because it allows government to collect money and utilize it to fund social projects and foster economic growth. Now let us begin discussing the different types of taxes, starting with withholding tax. The amount deducted from an employee's salary by the employer and paid directly to the government for the employee's partial income tax is known as withholding tax. There are two classifications of withholding tax. First is creditable withholding tax, which includes compensation, expended, and withholding tax on government money payments or GMP for value-added taxes and percentage taxes. Compensation is the tax withheld from income payments to individuals arising from an employer-employee relationship. Expended is prescribed on certain income payments and is creditable against the income tax due of the payee for the taxable quarter or year in which the particular income was earned. Withholding tax on GMP for value-added taxes or GVAT is the tax withheld by national government agencies before making any payments to VAT-registered taxpayers on account of their purchases of goods and services. Withholding tax on government money payments for percentage taxes is the tax withheld by national government agencies before making any payments to non-VAT-registered taxpayers or suppliers. We will discuss more about value-added tax and percentage tax in the next part of the video. Next is the final withholding tax, which is prescribed on certain income payments and is not creditable against the income tax. The second type of tax is business tax. Business tax is an indirect tax on the consumption of goods or services and is imposable only when the seller is a business. Percentage tax, value-added tax, and excise tax are all under this type. Percentage tax is a business tax imposed on merchants or businesses that lease or sell products, services, and properties. They are not VAT-registered with a yearly gross sale that do not exceed 3 million pesos and are exempt from value-added tax. The tax rate for percentage tax is 3% but was reduced to 1% under CREATE Law, effective July 1, 2020 to June 30, 2023. The tax form required to file for percentage tax are BIR Form 2551Q for the quarterly percentage tax return and BIR Form 2552 for the percentage tax return for transactions involving shares of stocks. Next is value-added tax or VAT. It is a tax on consumption levied on the sale, barter, exchange, or lease of goods or properties and services in the Philippines and on importation of goods into the Philippines. It is an indirect tax which may be shifted or passed on to the buyer, transferee, or lessee of goods, properties, or services. Here are the tax forms you should remember if you are qualified to pay value-added tax. BIR Form 2550M for monthly value-added tax declaration and BIR Form number 2550Q for quarterly value-added tax return. For the tax rates, 12% is imposed on sale of goods and properties, 12% also on sale of services and use or lease of properties, and the same with importation of goods. On export sales and other zero-rated sales, 0% is imposed. The last type of business tax is excise tax. It is a tax on the production, sale, or consumption of a commodity in a country, particularly on alcohol, tobacco, petroleum, and other mineral products. It is applicable on goods manufactured in the Philippines for domestic sale or consumption and on goods imported. The two types of excise tax are specific tax, which is based on weight or volume capacity or any other physical unit of measurement, while ad valorem tax is based on selling price or other specified value of the goods or articles.
Next, we have our third type of tax, which is the income tax. Income tax is a tax imposed on individuals or entities in respect of the income or profits earned by them. You may wonder why income is subject to tax. To answer this, income is regarded as the best measure of taxpayers' ability to pay taxes. The theory of cost allocation, which is the ability to pay theory, states that those who have a greater ability to pay taxes, measured by income and wealth, should pay more. So, who are required to file income tax returns? We have two types of income tax payers, the individuals and non-individuals. Individual taxpayers consist of the following citizens. First, resident citizens. They are the citizen of the Philippines who has a permanent home or place of abode in the Philippines to which he or she intends to return whenever he or she is absent for business or pleasure. Resident citizens receive their income from sources within or outside the Philippines. Non-resident citizens are those individuals who mainly resides in one region or jurisdiction but has interest in another region. Non-resident citizens receive their income from sources within the Philippines. An alien is any person who is not a Philippine citizen. Aliens, whether resident or not, receiving income from sources within the Philippines are required to file an income tax return. For non-individual taxpayers required to file an income tax return, we have the following classifications. First, corporations, including partnerships, no matter how created or organized. Domestic corporations receiving income from sources within and outside the Philippines. Foreign corporation receiving income from sources within the Philippines. And estate and trusts engaged in trade or business. Now that we already know who are required to file an income tax return, we should also learn about what tax forms should these taxpayers file. First, we have BIR Form 1700, the annual income tax for individuals earning purely compensation income. This return shall be filed by every resident citizen deriving compensation income from all sources, or resident alien and non-resident citizen with respect to compensation income from within the Philippines, except the following. 1. An individual whose taxable income does not exceed 250,000. 2. An individual with respect to pure compensation income as defined in Section 32A Wat, derived from sources within the Philippines, the income tax on which has been correctly withheld under the provisions of Section 79 of the Code, provided that an individual deriving compensation concurrently from two or more employers at any time during the taxable year shall file an income tax return. 3. An individual whose sole income has been subjected to final withholding tax are also exempt. And last one, a minimum wage earner or an individual who is exempt from income tax pursuant to the provisions of the tax code and other laws, general or special. This return is filed on or before April 15 of each year, covering income for the preceding taxable year.
Next, we have the BIR Form 1701,
the annual income tax return, individuals, estates, and trusts, which shall be filed by individuals who are engaged in trade or business, or in the practice of profession, including those with mixed income. This return shall be filed on or before April 15 of each year, covering income for the preceding taxable year. BIR Form 1701 AIF, or the Account Information Form to Self-Employed Individuals, Estates, and Trusts. BIR Form 1701Q, Quarterly Income Tax Return for Individuals, Estates, and Trusts. BIR Form 1702, Annual Income Tax Return for Corporations and Partnerships. BIR Form 1702 AIF, Account Information Form for Corporations and Partnerships. BIR Form 1702Q, Quarterly Income Tax Return for Corporations and Partnerships. BIR Form 1704, or the Improperly Accumulated Income Tax Return for Corporations. For the next part, we will talk about income tax rates. For individual citizens and resident aliens earning purely compensation income and individuals engaged in business and practice of profession, a graduated income tax rates is followed. We have here the amount of net taxable income and their equivalent rates. For individuals earning an income not over 250,000, shall have a zero tax rate. A 20% tax rate of the excess over 250,000 shall be followed for those individuals earning over 250,000 but not over 400,000. For those individuals earning over 400,000 but not over 800,000, tax rate shall be 30,000 plus 25% of the excess over 400,000. For those individuals earning over 800,000 but not over 2 million, tax rate shall be 130,000 plus 30% of the excess over 800,000. For those individuals earning over 2 million but not over 8 million, tax rate shall be 490,000 plus 32% of the excess over 2 million. And lastly, for those individuals earning over 8 million, tax rate should be 2,410,000 plus 35% of the excess over 8 million. For purely self-employed individuals and/or professionals whose gross sales or receipts and other non-operating income do not exceed the VAT threshold of 3 million peso, the tax shall be at the taxpayer's option, an 8% income tax on gross sales or gross receipts in excess of 250,000 peso in lieu of the graduated income tax rates and percentage tax, or income tax based on the graduated income tax rates which we have shared a while ago.
We also have final tax under the NIRC or the National Internal Revenue Code of the Philippines. Final taxes are prescribed on certain income. Once an income is subject to final tax, it will not be further taxed under the normal or capital gains tax. Income from different sources are taxed differently. The table shows different tax rates for every type of taxpayer. Under final tax, we have the following taxable income. First, we have interest from currency deposits, trust funds and deposit substitutes, royalties on books as well as literary and music compositions, royalties in general, prizes amounting to 10,000 or less, prizes amounting over 10,000, winnings in general, winnings from PCSO and Lotto amounting to 10,000 or less, interest income from a depository bank under the expanded foreign currency deposit system, cash and or property dividends, share in net income dividends, capital gains from sale, exchange and other disposition of real property located in the Philippines, classified as capital asset. We also have net capital gains from sale of shares of stock not traded in the stock exchange. And last, we have the interest income. For resident foreign corporation, we have the following tax rates. In general, we apply 30%. For minimum corporate income tax on gross income, we apply 2%. Improperly accumulated earnings, 20%. International carriers, 2.5%. Regional operating headquarters of multinational apply 10%. Regional or area headquarters of multinational companies are exempt. Other taxable income of the resident foreign corporation includes the following: corporation covered by special laws, interest income derived by offshore banking units, interest income derived under the expanded foreign currency deposit system, branch profit remittances, interest from currency deposits, trust funds, deposit substitutes, and similar arrangements, and lastly, royalties derived from sources within the Philippines. Next, we have the fourth type of tax, the estate tax. Estate tax is a tax on the right of the deceased person to transmit his or her estate to his or her lawful heirs and beneficiaries at the time of death, and on certain transfers, which are made by laws as equivalent to testamentary disposition. For example, when a loved one dies, their estate pays tax for the process of transferring their assets, real, personal, tangible or intangible, to their heirs and other beneficiaries. Any estate with a gross value of more than 200,000 peso must pay for an estate tax according to the Tax Reform for Acceleration and Inclusion or TRAIN law. Estate tax in the Philippines is 6% of the net estate. The BIR Form 1801 or the estate tax return must be filed within 1 year of the deceased's death. The BIR Commissioner allowed a filing extension of up to 30 days. Next, we have the documentary stamp tax. Documentary stamp tax, from its name, is a tax on documents, instruments, loan agreements, and papers evidencing the acceptance, assignment, sale or transfer of an obligation, right or property incident thereto. Who shall pay for the documentary stamp tax? The answer is, the tax is paid by the person making, signing, issuing, accepting, or transferring the documents. The amount of tax is either fixed or based on the par or face value of the document or instrument. We have two forms for this type of tax. First is the BIR Form 2000 or the Documentary Stamp Tax Declaration Return, which shall be filed within 5 days after the close of the month when the taxable documents was made, signed, issued, accepted, or transferred. And the BIR Form 2000OT or the Documentary Stamp Tax Declaration Return, one-time transactions shall also be filed and tax paid within 5 days after the close of the month when the taxable document was made, signed, issued, accepted, and transferred. Following the documentary stamp tax is the capital gains tax or CGT. Capital gains tax is the tax imposed on the gains presumed to have been realized by the seller from the sale, exchange, or other disposition of capital asset located in the Philippines, including pacto de retro sales and other forms of conditional sales. A pacto de retro sale is defined as a transaction wherein the seller has the right to repurchase the property being sold to him or her. For the capital gains tax for owner's transfer of real property classified as capital asset, the tax form is the BIR Form 1706 or the final capital gains tax return for onerous transfer or real property classified as capital asset. This shall be filed and paid within 30 days following the sale or exchange or disposition of real property. For the capital gains tax for onerous transfer of shares of stock not traded through the local stock exchange, the tax rate is 15%. The BIR Form 1707 or the capital gains tax return for onerous transfer of shares of stocks not traded through the local stock exchange shall be filed. If the sale is made through PSE, stock transaction tax is charged at a rate of 3/5 of 1 or 0.6% based on the selling price or gross value in money of the shares sold. For the annual capital gains tax for onerous transfer of shares of stock not traded through the local stock exchange, BIR Form 1701A shall be filed. Lastly, we have the donor's tax. Donor's tax is a tax on the donation or gift and is imposed on the gratuitous transfer of property between two or more persons who are living at the same time of the transfer. Under the National Internal Revenue Code, the tax for each calendar year shall be 6% computed on the basis of the total gifts in excess of 250 exempt gifts made during the year. The BIR Form 1800 or the donor's tax return shall be filed. This tax form shall be filed within 30 days after the date of gift or donation is made. And that is all for the discussion of Philippine taxes.